Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk with Ajay Kumar right here on ITV Gold. The show is brought to you by SAI CPA Services, a CPA firm located in the state of New Jersey with multiple locations. When you want to have your taxes done right, whether it's a personal taxes or your corporate taxes, to do your taxes right, you need to contact SAI CPA Services. They'll make sure that whatever you're eligible for, all the deductions and everything, and whatever refund that you're entitled to get, you will get the refund. Refund or non-refund, that's secondary, but to have your taxes done right, because in today's day and age, it's important to do your taxes right. Now, why am I saying that? Because in today's show, we're going to talk about something which is related to that topic, that why should you do your taxes right? All the helpful and meaningful information is coming up soon in this show. Once again, you can contact SAI CPA Services at 908-380-6876 or visit their website saicpaservices.com. With that note, I'd like to welcome Mr. Ajay Kumar of SAI CPA Services with over 25 years of experience, CPA and MBA with SAI CPA Services. Every week, he takes the time out of his busy schedule, joins us to actually share all the information when it comes to taxes. Ajay, good to have you.
Thank you, Sanjeevji. Thank you for the kind introduction.
Sure, very well. And like I said, that you need to have your taxes done right.
Absolutely.
Everyone wants refund. I know that.
You're 100% right. A lot of people are more focused on the refund than getting it right. And we always remind that you do not want to look for the refund. If you deserve the refund, rightfully so, you will get the refund. But more important than getting the refund is doing it right.
Exactly. And if I may say about SAI CPA Services, many firms, many CPA firms, you may hear from them that, oh yeah, they're going to get you best refund, come in our door, sit down with us, we're going to make sure that you get the maximum refund, this and that. SAI CPA Service never will say that. SAI CPA Services will say, we're going to do your taxes right, and whatever you're entitled to, you will get the refund. So that way your taxes are filed correctly, whether it's corporate taxes, if you're a business owner, or your personal taxes. Once you have your taxes filed correctly, then the chances are that your tax returns will not get audited.
Absolutely.
Because once a tax return is audited, that means it's a red flag. And today's show is all about IRS red flags.
You're 100% right, Sanjeevji. A typical IRS audit can take anywhere from 3 months to 3 years. It's not just about the money. There will be penalties. There will be tax owed, interest and penalties. IRS has 6 years after you file the taxes to come back to you to say this is what you owe. And a typical IRS audit, once it starts, can take years. The restless nights that you will have, the peace of mind that you will lose in those years is extreme. It can be very, very difficult for any family. We see a lot of families where the divorces are happening because the family is going through the IRS audit and the IRS auditors decided that they owe large amount of money. So it's very important for people to do their taxes right, not focus on the refund. Make sure it's done right. If you deserve a refund, if you are entitled to a refund, you get the refund. If you are supposed to pay, you pay your fair share. But make sure your taxes are done right.
When your taxes are done right, chances are very less that IRS will pick up that tax return for the audit. Now, let's say if someone's tax return is picked up for the audit, red flag and everything, let's discuss that. What are the common errors that accountants, CPAs, or even people who file their own taxes, they make it, right?
Absolutely.
And that's why you need to have a professional CPA like SAI CPA Service firm to do your taxes. So what is the number one thing? They say round numbers. How does round numbers create IRS red flag?
A lot of times, especially the people who are filing their own taxes, and a lot of these people, the small business owners, they have some consulting income, side income, solo proprietorship, single member LLC. They don't take time to calculate the actual number and they end up reporting everything as a round number. So the income 20,000, travel 5,000, utility 1,000, phone bill 2,000. See, you see the trend over here, Sanjeevji? Every number is in thousands. So just by looking at these numbers, you know that nobody took time to actually calculate the numbers. They're all rounded numbers. They're all estimated numbers.
And chances are that one or two numbers are inflated.
Inflated or underrated. The fact is that you did not do it right. It's not about refund.
Right.
In one case, the taxpayer used all the rounded numbers. The taxpayer got an audit. We called the auditor. We looked at all the numbers. We actually got $15 back after the audit. It's not about if you are getting the money back or if you are paying the money. It's more about, do you want to go through the audit? Do you want to use the rounded number? Why don't you take time to calculate all these numbers as best as you can and then report the real number as opposed to rounding up these numbers?
Okay. All right. So that's the one thing that you should keep in mind, rounding up numbers. Second thing is missing income. There are people there who may miss, could be one of the 1099s.
It's very, very common, unfortunately, especially the 1099 interest income, dividend income. A lot of wealth banks, the investment banks, they're not sending the paper copies anymore, Sanjeevji. The onus remains on the taxpayer to go to that website, to log into that website, download certain 1099s, and then report those 1099s.
Yes.
Please understand, a copy of those income statements, 1099, 1098, all those documents is submitted to IRS as well. So IRS knows what income you made. If you don't report every single income, when you file the tax return, your tax return will not be in sync with what IRS knows about you. That's the primary reason, because unknowingly, not intentionally, a lot of people will miss some interest income, some dividend income, some capital gain. People sell the house and the investment properties, and they forgot to include the capital gain taxes. They did not know what they did not know, especially when you're filing your taxes yourself. If you have a transaction of this sort, out of bloom transaction, out of ordinary transaction, selling the home, making large amount of money in the stock market, at that time it's very important for you to consult somebody who knows what they are doing, especially in situations when you have an out of ordinary situation.
Okay, interesting. These are the things, so one we talked about rounding numbers and the other one is missing income. Now the third one is excessive tax breaks, compared to income. How does that fall into red flag?
Right. So going back to our theory that everybody wants to save money. Everybody wants to pay the least amount of tax and wants the maximum refund. So there are a lot of creative people that we have seen where they have this side job, side income. They made $10,000 in consulting income and their expenses were $30,000 to do that consulting. They will claim a lot of travel, even though they're going for consulting once a week, twice a week. They will claim $20,000 in travel. But $20,000 is the lease payment for your car. The car is being used for personal reasons as well. You're going to do consulting once a week, twice a week. You only made $10,000. How could you be spending $12,000 on travel expense? So in a lot of cases, Sanjeevji, there are excess deductions. People claim a lot of expenses. Small income, large expenses. Then the question becomes, hey, you drive a BMW. You live in $1 million home. You have 2 children. How are you supporting that? Your total taxable income is $20,000. How can you drive a BMW, live in $1 million home and feed 2 children? A lot of times their income does not match with the lifestyle that they have. And that's what creates the audit.
Yep. You try to take advantage of IRS and you try to actually be smarter than IRS. And when you do these kind of things, it's not worth it.
It's a matter of time. The system is dealing with 200 million people like you. So they will take time. But it's all computerized. Sooner or later, we'll see how much mortgage you pay, how much car payment you pay,
exactly.
how much down payment you paid. This is all electronic transaction. The system will eventually catch it up.
Because numbers can be traceable. With the categories, numbers are traceable.
It's and then all linked to your social security number.
Yeah, absolutely.
We can easily find out how much money you made, how much money you paid, and the amount of money you are paying year after year is far more than the amount of money you are paying taxes on. So where is this money coming from?
So now, as a taxpayer, whether you're filing a tax return as a single or married jointly or separate and widow or head of household, whatever it is, right? You all know about standard deduction. Everyone knows about it. But how come earned income tax credit can create IRS red flag?
Great question. So earned income tax credit is a way for the government to give more money back to poor families. So if you go back to our excessive deduction, if you are making $20,000 and you are claiming $30,000 of deductions, your taxable income goes down by $10,000. So if your taxable income is much lower, then the government will give you money. We call it earned income tax credit. This is given, it is thousands of dollars. It's over $6,000. So if the government is giving money based on the lower income that you are making to support the family, and if the audit find out that your income was not lower, because you claimed excess deductions, then you did not qualify. You shouldn't have qualified for the earned income tax credit. Take it again. Earned income tax credit is given to you only because you did not have enough income to support the family. If we find out you claimed unnecessary deductions, excess deductions, and that's why you dropped the income, we gave you the earned income tax credit you should not have qualified for. That's what creates the audit.
Oh, I see. Good to know. Now, here's the one interesting fact that we should share with our viewers. Between fiscal years 2015 and 2019, audits dropped by 75% for taxpayers making $1 million or more, and 33% for filers claiming the earned income credit, according to a 2021 report from the Treasury Department. So, as it is, I mean, it can create a red flag.
It does. In 2023, IRS was giving $80 billion.
Yeah.
Now the audits are coming back up again. So IRS audit rate was going down year after year after year for last few years. So 2023 was the year when IRS was giving absurd amount of money to revamp the system, revamp the software, increase the audit again. And remember, doing audit is a profitable business for IRS. The amount of salary that they pay to the auditor and the amount of money they collect from these audit, the ratio is absurd. So it's a profitable business. They just don't have enough people. They don't have enough money to hire these people. And IRS was giving $80 billion over next 10 years that they can spend to ramp up the audit rates.
I have a question. This is, before quickly we go into the break. This the IRS auditors and everything, right? And obviously IRS needs more auditors, and they've been hiring more people. Are they given some kind of target that they must collect X amount of money in a year or something?
Yes and no. So a lot of these auditors, and we deal with a lot of these auditors, they are extremely nice people, very, very nice people. They have a government job. They don't want to be bothered. Their job is to close the audit, not to collect the money from you.
Okay, good
to know. So they are giving certain targets as how many cases they have to close, how many cases they have to be working on. Each auditor can be working on 30 to 40 cases at the same time.
Nice. Okay.
So these auditors are extremely busy, especially these days with the lack of number of auditors. So they are working on many cases. They are giving targets to close the cases, to work on these cases. There is no such target as how much money they have to collect. There is no financial target.
All right, that's a good to know. Now it's time for us to take a short break. When we come back after the break, viewers, we've got a very important topic for you as part of this show, and it has to do with foreign accounts, all the information that you need to know. That's all coming up right after these messages.
Did you know there is a country where giving bribe was legal? Giving bribe was a tax deductible expense. Up until 2002, in Germany, if you are giving bribe to anybody, you could legally deduct the bribe amount. What's the downside? You have to report who you gave the bribe to, because that person has to report in their income tax how much bribe they got, and it's taxable to them. It's not there anymore. The bribe is illegal in Germany now, but I thought it was interesting to know.
What was the point of having that thing? What was the point?
It's amazing.
Because you give person a bribe, and then you have to report, you have to mention that person's name and the amount, and that person has to report it as an income.
The way it was seen up until that year in Germany, of course, cost of doing business. Giving bribe was normal cost of doing business. So person who is giving can deduct it. The person who is getting it has to show it as income.
Oh man, interesting. All right, so that's a Did You Know segment in our show. All right, let's continue our show. Viewers, in case if you have just joined us, today's topic is IRS audit and the red flags. What are the categories and what are the items which can cause your tax return to be audited by IRS? We covered a lot of things in the first half. Now let's continue second half. As I mentioned, one of the most important things, and so as long as I know AJ for a decade or so, more than that, he's been always talking about foreign accounts, to report the income in the foreign accounts, and that's what now we're going to be touching upon. Give us more information about this foreign account, why it can cause a red flag.
Absolutely. So a lot of banks, foreign banks, ICICI, HDFC, Citibank, now those banks are directly reporting to Treasury the list of accounts where they have the social security number. It was not the case. If you go back 10 years, these bank accounts, ICICI, HDFC, they never reported to Treasury. Now, under the KYC, it's mandatory for you, if you have an ICICI, NRE, NRO, any account, for you to give your social security number to them. At the end of the year, they are supposed to report it to the Treasury. So now the Treasury can track how much money you have. The rule is under FinCEN, Financial Crime Enforcement Network, there are at a high level two types of filing requirement: FBAR, foreign bank account reporting, and FATCA, the asset reporting. So in FBAR, if you had more than $10,000 in all the bank accounts combined together at any given point of time during the prior year, you're supposed to report those bank accounts in your FBAR. FBAR does not create any tax liability, it's just an information reporting. But if you don't have FBAR, on Schedule B, if you don't answer that question right in Section 3, that you have the FBAR, or if you don't have the FBAR, that can potentially create an IRS audit. When it comes to asset reporting, FATCA, in a married filing joint tax return, if you had more than $100,000 of asset at the end of the year, or more than $150,000 of asset during any time of the year, and the asset could be land, inherited property, rental property, investment property, the house that you used to live in, any asset that you have, non-liquid asset, if the value is over 100,000 at the end of the prior year, or it was 150,000 at any point of time during the prior year, you are supposed to file Form 8938 under this requirement. If you don't have that form, that can potentially create an IRS audit.
Good to know. So viewers, just look into your portfolio, and if you have foreign accounts, make sure that you report it, just for information purpose.
Absolutely.
As you said that. All right. Now the next thing is, in the year 2022, IRS audited about 1% of the tax returns of the taxpayers who were earning less than $200,000, but about 4% of those taxpayers earning more than $200,000, and that can cause a red flag. Why is that?
More money you have, hypothetically, more complex the situation you have, more moving pieces you have, and if you forget about that, more money you have, more money potentially IRS can collect from you. It's a business. If we have an auditor, we are running short of auditors anyway. If we have an auditor, where do we want to put this auditor? Somebody who's making $20,000 or somebody who's making $200,000? Somebody who's making $200,000, if we can look at their tax situation, same amount of time is spent, potentially we can collect a lot more money than somebody who is just making $20,000. So people, more money that you make, typically more businesses you have, more complex the situation you have, more moving pieces you have, more financial accounts you have, more foreign accounts you have. So the tax return becomes more complicated, and it's easier for the auditor to find something that was not done right. At the same time, if you are making more than $1 million, your audit probability is more than 12%.
Okay.
So you have more money you make, better service you need, more qualified person you need. If you are making $10,000 a year and you are doing your own taxes, good luck to you. If you are making $1 million and you still are doing your own taxes and making a mistake, shame on you.
No, better good luck to you because chances are that it could be audited.
So once you are an accredited investor, once you are making more than certain amount of money, once you are making more than $250,000, the onus shifts to you. You have to know better what makes sense in your case. You have to find somebody qualified, somebody who you can trust, guide you in the right direction to make sure you are doing it right. It's not about refund. It's not about paying the lowest taxes. It's more about doing it right when it comes to the taxes.
That is very interesting to know. And you're making more money, and then I think it's better to go to SAI CPA services and have them do your tax returns, because some things, in case if you missed it, they will actually help you out by addressing those things, and they will make sure that your tax return is filed correctly. Now, there has been a surge in this kind of business. It's CBD and marijuana and vaping and everything else, right? Now let's talk about this. Marijuana has become legal in some states. So now let's talk about is, if somebody has a business which is focused on marijuana, how do they should be careful filing the tax return?
Absolutely. So especially for the marijuana business, and you have to take a step back. I'll explain you why the rule was made the way it was made. In marijuana business, when you file the taxes, you cannot claim SG&A. So in a typical business, when we file the taxes, we claim the rent, the utility, the travel. We claim a lot of selling, general and administrative expenses. In a marijuana business, only the cost of goods sold is deductible. The shipment cost, the shop cost, the rent, utility, property taxes, association fees, all those costs are not deductible. And you have to take a step back. You say marijuana is a business too. Why are they not allowing certain costs to be deducted? The rules were made when marijuana was not legal.
Correct.
At that time, they wanted to discourage it. If you are doing something that we are telling you is not legal, this is what you have to do. Now, since marijuana has become legal, I'm sure sooner or later, somebody has to look at these rules as well to see if these rules can be relaxed and can at par with the other businesses. But as far as now, marijuana business does not allow other SG&A costs to be deducted from the tax return. Only the cost of goods sold is deductible.
Okay, very well. Now quickly, before we end our show, let's touch base upon two important things. Active rental losses.
Absolutely. So active rental losses, there are two things, active losses and the passive losses. When it comes to the rental losses, if you have a W-2 job, if you have a business and you have a couple of properties on the side, you are not spending enough time on those. If you are spending less than 1,000 hours in a year in managing the rental properties, or if you are a realtor, real estate professional, in that case you can say this is what my business is. Otherwise, just collecting the monthly rent or going once or twice in a month over there to fix the property, that's not active, that's passive business. You cannot have the passive expenses or passive losses deducted against your active income. W-2 income, your business income cannot be offset against the passive losses that you have from the rental properties. Okay. A lot of people make this mistake when they qualify, when they claim their rental business is active, which it's not supposed to be active because they're not spending enough hours. If you think your rental business is active, please make sure you keep the log, how much time you spent on which activity. And then at the end of the year, you show you have a proof that you are indeed spending more than 1,000 hours on this business. And that's why your business is active business.
Very good to know active and passive losses when it comes to rental. All right, quickly, the last topic, single member LLC and sole proprietorship. How does that catches IRS eye?
Well, single member LLC or Schedule C business or proprietorship, all the same thing. That's probably the highest audited section in any tax return. In a personal tax return, Schedule C is an area where you can make up the expenses and offset your personal income. A lot of people have this side business, shell business, where they're really not making any money and they end up showing $5,000, $6,000 of expenses every year only to reduce their W-2 income. That's why IRS is scrutinizing Schedule C, single member LLC or proprietorship, to see if there is enough money coming in. And if the losses are shown year after year, if you are showing 10,000 loss in the last year, 10,000 now, then IRS says, why are you even doing it? What's the point of having this business where you are losing money every year? Why don't you just close the business so you don't lose the money? So that's why Schedule C, single member LLC, proprietorship are highly audited side of the business.
Okay, interesting to know that single member LLC also can make a difference. Now quickly, first of all, viewers, I just want to say that in case if you're audited for any one of the years, 22, 23, and if you didn't do anything, then please do contact SAI CPA services, because one is that if you get IRS audit letter, you don't need to be scared, and don't just put it on the side and not do anything. Immediately take action, and if you are confused, that's when you need to contact SAI CPA services, because they will guide you right direction, and if needed, they will speak with the auditor once they review your tax return, and they will make sure that everything is okay, or whatever the question is, they will answer it, because SAI CPA services, they're trained and knowledgeable staff with the CPAs on hand, can definitely guide you in the right direction. So please do make a note of that. Now AJ, in the end, if you can, if someone is audited, or before someone gets audited, what are the things that they should keep in their mind? Quickly, just run down the points.
Absolutely. So if you ever get audited, very first thing, as Sanjeevji said, do not get panic. Most importantly, do not ignore it. Take a copy, give it to the accountant who filed the taxes, let them look into it. Respond, even if it's not your fault. Make sure you respond to the notice. You explain your side of the story. Keep it in writing. So tomorrow, if the IRS says that they never received a response, you have some proof. IRS gets millions of letters, so make sure you have a proof that you responded to the notice. The onus remains on the taxpayer for responding to such notices. Do not ignore it. Bring it to a CPA, bring it to the person who filed your taxes. Let them look into it. Let them respond on your behalf.
That is the one thing. And on the screen, viewers, we're going to have a one page for you that, what to do if your tax return is audited. All right. So we're going to have that on the screen. You can make a note of it. In the end, AJ, let's have.
Well, today's quote.
Yes.
Viewers, if you can count your money, you're not working hard enough. So please, make sure you're working hard enough and you're making enough money, saving money, paying your rightful taxes. Do not worry about refund. Make sure you are doing the taxes right so you can sleep peacefully.
All right, so that's a tip. AJ brings that the quote, start counting your money, and if you can count all your money, that means go back to work and continue to work harder and harder. With that note, we come to an end of this week's episode of the Tax Talk with AJ. AJ, thank you so very much for your time. And we thank SAI CPA Services for sponsoring the show. Remember, their phone number is 908-380-6876, or visit their website, saicpaservices.com. I am Sanjeev Pandya. Until we meet again, wish you all happy and tax-free days ahead. So long.
Thank you.